Scalping, or scalp trading, is a short-term trading strategy that enables a trader to make small profits from daily, small movements in the price of an asset. By adding up these small profits from each trade, the trader can generate a significant amount over time. Due to the cryptocurrency market's volatility, scalping is a common strategy, as scalpers usually use leverage to place more trades and tight stop losses to manage their risks. In scalping, the main factors that determine success are speed and consistency. Crypto traders use this strategy through quick responses to market movements. Instead of holding a position for days, weeks, or even hours, scalpers tend to make their decision within minutes or seconds. To use the scalping strategy, the currency pair needs to be highly volatile because, through short bursts of volatility, there are significant movements in price, and scalpers use these price changes to generate profits. How to make money with a crypto scalping strategy? Each trader forms their trading system to make money from crypto scalping to receive the highest possible profit. However, some traders share their trading principles. The scalping strategy only works when there is real-time technical analysis. Averagely, scalpers open positions every 5 or 10 minutes. Still, the M5 timeframe is the most preferable because it works with other strategies and is open to analysis, increasing its predictability chance. Scalpers open dozens or hundreds of trades daily. There are two approaches to crypto scalp trading: manual and automated, further discussed in this article. Timeframes in crypto scalping. Through the scalping timeframe, a trader can achieve trading velocity, or the number of trades made. Typically, the most preferred timeframe for scalping ranges between 5 to 30-minute charts. The greater the number of possible trade setups, the smaller the timeframe, but this wholly depends on the strategy you choose for scalping. In crypto scalping, you can collect various profitable trades within the day, with significant culminated profits. Pros and cons. There are many advantages of scalping, and there are a few disadvantages of scalping. They are: pros: if executed precisely with a strict strategy, scalping can be very profitable. As a trader, you have to implement a strict strategy to stay profitable. In scalping, there are numerous opportunities to leverage small changes in the price of a crypto asset. Sometimes, these small changes may not reflect the overall trend of the asset's price for the day. Since scalpers don't play a significant role in dealing with a short time frame, they don't have to follow the fundamentals. This ensures that traders don't need to know much about crypto before trading in it. In scalping, minimal market risk is involved. Scalping or scalp trading is a strategy in which a trader takes advantage of small price differences to make profits. Traders who use this trading strategy do not target massive profits at once, they rather try to make profits from small price movements over and over again. For example, a trader buys coins at a lower price and makes quick profits by reselling them at a higher price. The trader then repeats this process to profit from minor price movements. The rationale behind this trading strategy is that the little profits will add up to become a substantial amount over time. Scalpers, traders who carry out scalp trading, also believe that small moves are easier to get from the market and that less exposure to the market reduces the chances of adverse losses. Short timing and quick decisions. Scalpers do not stay in a trade for a long time. A typical trade may last from a few seconds to 15 minutes. However, they open many positions within a day and seek to profit from them. Since the trades are very short, the strategy also requires making swift decisions because trading opportunities can present themselves at any time. This is also not to downplay the role of fundamental analysis in scalping. Due to news or events, a crypto price can suddenly attract more traders or have a higher trade volume. Such a market could be a good one to scalp. Use of leverage to boost profits. Since the price and profit targets are usually small, some scalpers prefer to use leverage to make far more than they can ordinarily make with their balance or stake. This is why many short-term traders prefer to trade crypto futures markets and other markets that offer leverage trading. A range-bound market, as the name implies, is one in which prices move between a specific high and low price for a specific period. The range forms both resistance and support for the price. The high price forms the resistance, while the low price is the support. The ranging market usually has a sideways trend, and what scalpers try to do is make profits off the restricted movement. In this market, traders try to buy at support and sell at resistance. They can also choose to have multiple entries at different points by using limit orders, since they know the range at which the market is trading.